Ladies and gentlemen, welcome to today's webinar. I'm Joseph Novichkov, Senior Trading Manager with GDM. First of all, ladies and gentlemen, let me apologize for this Wednesday's webinar. I was in no condition to come down to the office to lead the webinar, as well as I'm still having a little bit of problems with my health. However, I suppose in the next few days I'll be feeling much better, so I hope I'm not going to bore you to death with today's session, which in fact is the one that should have taken place this Wednesday. And this would be our third webinar for this month. We will be talking about another a type of a range breakout system based on the 30-minute chart. So without taking too much of your valuable time, especially before I start coughing and sneezing on the microphone, I will just go ahead and take it from here. First of all, let's remind for those that are coming just about now on these webinars and they have registered a couple of days ago and they've missed the first two sessions. What we took under consideration was in the first session we had a 15-minute swing trading system that was based strictly on the performance of the Fibonacci founds. Basically, we've been mostly relying on support and resistance levels from weekly charts down to 30 minutes and 15 minutes charts, so we can better find where the stops are, and basically on these breakouts were our entries. We spoke about what is stop losses, but briefly what I mean is whatever you've missed, or those webinars are recorded, so you can just go to our YouTube channel and review what you've missed. On our second webinar, of course, we took advantage of a revised moving average trading system, which is pretty well incorporated within the 15-minute swing system that we took under consideration the first time. We've been using the stochastic oscillator with a bit of a different setup. Of course, two new moving averages and their crossovers, along with the stochastic also with different periods. We've been mostly focusing on small time frames like 15, 30-minute and 1-hour charts. Basically, we've been devoted to our day traders, as well as some of the scalpers. Of course, they can also use these approaches, of course, with the exception of the possible risk and the alleviated risk in these cases, especially when you're taking more than 10 to 15 positions per day. This is, how to say, a bit too much for the brain to sustain in one trading day, and of course to keep you running for the rest of the trading week. Today, however, ladies and gentlemen, we will be focusing on a 30 minutes trading system, which will be also based on a breakthrough from ranges. How to find that out, and what we need to know is basically where our average range lies, and where exactly this particular breakout occurs, what signals about our positions, what we should consider when trading breakouts from ranges, and all of this in today's session. The first of all I'm going to start with is the indicator that we're going to use. We have not implemented so far in any of our strategies, so as we've said, new strategies come in every day, so you can rely on new indicators, new combinations suitable for any type of particular trading plan, and of course for the needs of different individuals. Today's session, ladies and gentlemen, will involve the average true range indicator, as it can be found into our custom indicators. It is as abbreviation of ATR, which stands for average true range. This will be the first indicator that we're going to use, as well as, of course, I can understand that from further notice from what we're doing today, some of the combinations might not be allowed in different types of platforms or any other platform that is used by, like MetaTrader 4, for example, but used by another broker that is not really allowing combination of different indicators in one indicator, which we can strictly say that this is allowed in all matters with us, and you will see how you can do this at home, how you can input it, and of course benefit from the beautiful inputs with the combinations of all of these. First, let's take consideration on the visualization of this average true range. We need a bit of a thicker line on the indicator. Also, the inputs of value. This is something that we will talk about in the next few minutes. First of all, I want you to have a look at it. You might already be familiar with the average true range, but for those that are actually meeting this particular tool for the first time in their trading lives, I will step into a little bit more details, but not too much, not too many details. So I'm still going to try to keep you interested in this. The first thing we need to know about the average true range is that it's developed with the only purpose that it's volatility-based indicator. And of course, as with the most of the indicators that have been, of course, volatility-based and are mostly used to trade commodities on its daily price range in mind. The combination of today will allow you to get down to smaller time frames, such as the 30-minute time frame, which is a very good time frame, especially when we talk about ranges, breakouts, confirmations, return to resistance levels, so on and so forth. You will see how this particular tool works for you. Now, often, of course, this indicator has been a subject to gaps, of course, and in most cases, it limits the moves of the traders. However, the importance of it is that actually it protects you from major volatility events in force majeure situations, like major announcements, geopolitical events, something that it's not on the daily calendar, something that it's not expected anywhere or from any trader. This volatility indicator is particularly accurate to keep you safe in situations dire in any account necessary. The creation of the average true range has been made to capture the missing volatility in other tools. So it's a bit more sensitive to price action movements. It is important to remember that the ATR does not provide an indication of price direction. It is very important to remember that. It does not give you price direction, or basically it's not going to tell you where the market is going, up or down. It is just measuring the volatility, but it's measuring it much more accurately than any other indicator because it's not trying to show you any direction. So how to find this direction? It is very easy. By far, we already know that when the price breaks above a resistance level, it is pointing to an uptrend, and if it's falling below a support line, it is pointing to a decrease in value. However, the indication of the ATR and the volatility that measures will actually give you the strength of the moment, or basically in the next few candles you can rely on a very good profit. And something like this usually occurs not more than 2 times a day. So basically this strategy is not only quite accurate, but it's actually quite conservative as well. So it allows you to make 1 up to 2 profits on a daily basis, basically because a breakout of a range can occur pretty much not more than 2 times a day, because there is not so much time. You have about 12 hours to conclude your business for the day. So the concept of the ATR starts with the actual true range at first, which is defined as the greatest of the following current high less than the current low. The method number 2 could contain the current high less with the previous close, which is the absolute value of the price or the instrument that you're trading, or basically in this case the euro versus the dollar. And of course the current low, which is less the previous close, which is also the absolute value. And this absolute value, ladies and gentlemen, is used to ensure positive numbers. So basically, you cannot get a negative volatility, because this is, how to say, it's not possible. You always get volatility. Either it's down to 0, or it's 0 point something, or it's 1, which 1 meaning is by the higher capacity the market can go. So actually, you don't really have a value more than 1. But the closest the value it gets to 1, the closer the volatility gets to its end, so, or to shrinking down. So the only way to use this indicator is from the bottom up. And what I mean is using it by a standalone indicator, ladies and gentlemen. The only way you can use that indicator, I'm sorry, my voice is just shutting down from time to time, so please excuse me for this. When we hit a bottom in volatility, we of course have only one direction of the volatility to go. It has to go up. But with that does not mean that direction should also be up. That's absolutely wrong. The direction could be down, the direction could be up, and sideways is the only range-bound volatility that we can get. And of course, preceded by the decline of the volatility, which we can see from this situation. Once the volatility started declining, the market gets inside a range. So far this range goes where the volatility starts picking up again and the market finds a direction as well. When we start scrolling back, ladies and gentlemen, on this chart, you will also see how this is true for downtrends as well. But before we actually get further to this, let me prove this theory and scroll back a bit. Let's have a look at a downtrend. Okay, so far we had a very good up movement from the euro dollar. Recently, of course, we had some downwards movement. Excuse me for a moment. So in this situation here, ladies and gentlemen, we had a brief up movement, very strong. Along with that, the volatility risen. From then on, the market started cooling down. Price dropped to its original place, 100% of retracement. This is actually a beautiful head and shoulders formation. For those more experienced to that, can also verify that. Once the volatility drops to its end, a new trend begins, and of course keeps going in the negative direction, but the volatility keeps rising, ladies and gentlemen. So you can see here, first we had a very huge volatility. It reached a top, a peak of the volatility, and that was just a correction, from where the correction in the volatility brings the price slamming down with a very, very huge price difference, and the volatility keeps rising to levels close to 1. So what we've learned so far is that we cannot use the average true range as a standalone indicator on a small time frame and pick a market direction. We need something to show us direction of the market. Also, we need something to tip our odds in our favor, so we can pick the right moment when the market is ready to be traded. How to do that is very, very simple. We only need to implement a moving average. The only moving average we need is the same period as the average true range. That is a period of 14. Why we're choosing the period of 14 in this case? Now, it is important, ladies and gentlemen, to remember the calculation of the ATR. I'm only going to briefly tell you why we're choosing this. But we're not going to go through calculations. For those that are very interested in this, and they're interested from an investor point of view, so they can use all of this for longer time frames like a daily chart, weekly chart, so they can predict long-term cycles. This we can discuss in some in a private session, in a one-on-one session, as we usually do it. The only way to get this done is to get to our support department or your account manager directly in the firm to, of course, schedule a session with me so we can talk it over and smoothen things out that you're getting concerned about, or whatever questions you might have. Also, I have to remind you that getting private sessions would be only possible if you are a client of ours or that you're trading with us, with regardless, of course, the amount of the account that you have. So typically the average true range is based on 14 periods and can be calculated on an intraday, daily, weekly, or monthly basis. But that, of course, does not exclude the smaller time frames. The only reason that it's mostly used on larger time frames is because people are mostly interested in long-term cycles to determine market strength. And furthermore, with the combination of the moving average with the same period can give you the possibility to trade the daily market. How to do that? We can simply smoothen out the things, cut out the those fluctuations that we're getting here in curves, so we can smoothen these out by the only way possible, by bringing a moving average on top of this average true range. This is the moment where I have to tell you that a lot of brokers might not be able to allow you to drag a moving average from your navigator bar directly over your ATR to select the period, which is of course 14. I have preset a color which will resemble better on the blue ATR, so we're going to take a red moving average, which is of course a crucial point in our training today. And of course, the very important application, it has to be to the previous indicators data in order to get it on top of the ATR like this. So, ladies and gentlemen, let's take a look at the moving average. What does it give us? When we take crossovers of the moving average in timelines like these, and I'm selecting only the timelines which are with a rising moving average and an ATR above that moving average. You can see that I'm not even going through the crossovers which are with a declining volatility and declining moving average. And over here at the beginning of the cycle as well. Now, what you're getting, ladies and gentlemen, are strictly cycles of the market. Why I am doing all of this, I will show you why in just a few minutes. Okay. Now, why have I selected this particular cycle here and I left it a very big cycle here without taking this one? Well, this is the one moment where the ATR is actually getting you, how to say, getting you ready for something that it's coming up on the market, something big coming on the market. And basically, let's say from the beginning of the cycle, you've been on the market and you wanted to get out of someplace. How we will see later. But in this case, in this force majeure situation, because if we take a look at the market case on 29th of January, so we will basically see that at this date there was something major on the market causing the euro to slam down versus the dollar. Of course, this is one of the jobs that the ATR is particularly flawless about. Now, the way we selected those cycles are usually, there is usually a possibility that you can filter those by taking on these period separators. You can see how the day is usually over. Okay, we have one day here, another day here, another day here. There is a weekend. This is the weekend, and this is Monday to Tuesday. Now, you can see that every start of the cycle is particularly just about a few hours. Like a few is not exactly what I wanted to say, but 3 to 4 hours up to 5 hours after the opening of the market. So everyone knows that the spot market or the currency market is virtually 24/7, right? It is actually. That means for a cycle to develop a certain direction, or let's say a particular strength, a volatility, it needs some time to gain traction. Gaining traction means that from this particular time frame to this time frame, this is 17 candles, 17 sessions by, of course, 30-minute chart. So that's that is a time frame where the market is usually into the Asian session, ladies and gentlemen. From the beginning of the late Asian session to the beginning of the European session, we can all see that on the Asian session breakout, we have a spike with large volatility that sets the direction on the market for the rest of the session itself. Major corrections, major retracements like force majeure events like this one, or something major on the economic calendar that can change direction of the market is of course possible, and the ATR is preventing you from making mistakes by letting you know that the volatility is already too great, and in this case here, ladies and gentlemen, telling you that it's even going to get stronger. So market direction is not the one that you need, and it's going to keep going worse if you are on the wrong side of the market. So you have the chance to walk out much earlier than you ever anticipated. So the first 17 sessions, or that's about what? It's about 5 hours, 6 hours. So let's say about midnight, European session, European time, let's say, we have about 5 hours. That's until just about the market open of the European market, because we're talking on in our local time. So for those that are interested in Asian markets, they have to stick a little bit longer in the evening so they can trade that move, particularly this move or this move. What we're focused on is the range breakout. So we are preparing ourselves by setting a range from the previous session. And the range from the previous session, or let's say the previous day, is from here up to over here. And you can see that from the market action and the recent volatility, we have a direction. So any of these candlesticks here are an entry point for us because the range has already been broken, and it is going to be retested a couple of times more until the market finds a direction. And then at the tip of the uptrend, in this case, the market is telling you, walk out, now is the time. So let's head something greener. And we can see that the crossover of the ATR hitting below the moving average is actually where the end of the volatility is, and the market is telling us that it's time to walk out. So let's say you've taken this opportunity, by far the most conservative type, and you've walked out on the closing. This is about 21 candles. That's 21 by 30. Calculate how many hours that is. It's about roughly about 10 hours here. This is about direction of about 38 pips of profit, or about 40 pips of profits. That is for one day about $400 in one lot only. But you have a system that tells you market direction from the beginning of the day and how strong the market is during that period, telling you where to exit. And obviously, your particular stop loss should be by far below this particular range, because the market action momentum can cross the lower boundaries of this range anytime. So basically, when you've opened a position here and you already see two huge bullish candles breaking above this range, is for sure telling you the market is going to keep going up. So this particular strategy, ladies and gentlemen, does not give you a large amount of pips, but it gives you much more certainty on one trade, up to 2 trades maximum. I'll tell you why 2 trades maximum, because once it is possible that this particular session will be over here, you will take your profit or partial profits, then the volatility will drop, and then you will keep going with the rest of the your position, if that's what you've done so far, and you've hold on to the position until the next signal that crosses the ATR above the moving average, signaling you strong volatility, and the market is getting back into previous session range. But of course, your range by far will be very much different, because now this is your range. Your previous range close, your previous range open, or the highest point of your previous range, to the highest point the market reached, and the breakout is somewhere here, with, of course, the volatility keeps rising until this end, giving you about 90 pips of profit. And this, for one session, is about $900 with one lot. Now let's get a bit forward here to get this final case in this stage, ladies and gentlemen. This is the other crossover that gives you the possibility to trade the market. However, this breakout of the range, which of course we can see the previous session, the range is like this. So we have, this is an upper range boundary, this is the lower range boundary. So even if we have a volatility that it's rising, it's not rising that much, so it can break this range. The only breakout occurs over here in the system of candlesticks, in this breakout position in this session. So actually the confirmation here is enough to take your trading up to 2 sessions after, giving you a profit of roughly 200 pips. To be more accurate, actually, the range, the trade should be over somewhere here, and if you've taken the conservative ways, roughly about 165 pips of profit. So still, for about 2 days of trading, that's $1,650 with one lot, which is only one lot, and you understand that you need to have about $1,500 only to trade one lot. And you can see that in about 2 days you are possible to double your account without a problem. But first, this is if you are too aggressive with your positions and going all in to everything. And of course, that's depending on your leverage, whether your leverage is 1 to 100 to trade with one lot will cost you about $1,000, and you will have about 500 guarantee, or your leverage is about 1 to 500, which is roughly going to take you about $250 to trade one lot. But of course, that is a different story. Anyways, that's all about the session today. Let's mention one more time what are the important rules here. Now, rule number 1, taking component direction, ATR should be above moving average, crossing from below to above. And of course, let me mention that the volatility should be very, very weak during that time, close down to 0 or to the bottom of your chart, basically. And from then, the volatility starts rising, crossing the moving average because it's much slower than the ATR, no matter the period that it's one and the same, which is 14, and for the moving average also 14. It is an exponential moving average, also to mention. Rule number 2, draw the range of your last session. Your last session's range will be the breakout, whether upside or downside the range, from where you will consider the market direction. And of course, rule number 3, take profit on the ADX crossing down the moving average. It is as simple as that. Nothing complicated. That is why I have to mention one more time, ladies and gentlemen, it's very important to take it down to the minimum tools that you are using. The more complicated your chart looks, the more difficult it will be for you to distinguish between the signals, the confirmations, and of course, further on, take profit, stop loss, market direction, so on and so forth. Do not make your chart look like a Jason Pollock painting, because it will be very difficult for you to distinguish between the differences, and of course, finally, to make your decision. If you need a little bit of time to get your story straight, to find out what kind of trader you are, what would be the suitable type of strategy you need. If that's something that you need, we will be always ready and to help you find that out for yourself, and of course to develop a very successful trading plan, implement it with a successful trading strategy to keep following the market, its directions, profits, and so far, of course, our support, which is on the highest level in the industry. That's all about today's session. I'm grateful for your, of course, patience and attention in today's session, besides the fact that I'm a bit ill. But I promise you, next week I'll be in my top condition. And of course, we will take it from there with the next webinar, which will be, of course, strictly Asian session breakout system. Simply, we spoke about the European session breakout today. Now it's time to take a step back and to see what happens during the Asian session. What makes the market move in a direction, significant direction? Basically, it is in very rare cases you will see ranging market on the Asian session. That is why we'll go down to even smaller time frames to see how we can take advantage on later hours for European and US traders or any other traders which are in a time frame which is close to the European session, and for those that are strictly trading in the Asian session, what to look to trade, which news will be much more aggressive with an impact over Asian currencies. We'll take a look at some exotics, and of course, if you think about something that you want to see, a currency pair or any type of commodity or an index, please make a suggestion next week on Wednesday with the 4th webinar for this month. Thank you for joining us. I was here for you and for you only. See you next week. Bye-bye.